Hey guys, it's Simon, and today we're going to be talking about the Greeks as it pertains to options. So the option Greeks are measurements that help traders estimate how changes in the various factors could impact the options premium. So we'll go through them one by one, and at the end, I was trying to figure out a good way to do a visual on this because it always helps me to learn things when I see things and how they work. So at the end, I have a little example of how all of the Greeks work together with an options trade. So stick to the end; it's totally worth it. So we'll start with delta, and delta measures how sensitive an option is to a $1 change in price of the underlying stock. So if you have a stock that goes up a dollar, your delta will move that amount. So for example, if you have a long option call with a delta of 55 or 0.55, then if your underlying stock goes up a dollar, then your option will increase by 55 cents. So on the other end, if you do a long put, if the underlying stock goes down a dollar in price, then you'll lose 55 cents on the option. So deltas are either a positive number, which means they'll either go from 0 to $1, or they're a negative number, which means they'll be from 0 to -1. And that's dependent on whether you're doing a call or whether you're doing a put. Now, the larger the delta, the more sensitive an option is to changes in the underlying, which means that if the underlying moves, then the delta will move more. So you can also think of it in the terms of moneyness. So whether it's in the money, at the money, or out of the money, if an option has a delta from 51 to 1 or 51 cents to $1, that means it's in the money. If a delta has is at 50 cents, then it's at the money. And then if it's out of the money, then it has a delta of 0 to 49. Now, as the delta moves further into the money, it gets larger, and it gets smaller as it moves further out of the money. Hence, that last statement that I made before this one makes sense because the more you're in the money, the larger the delta is. And the opposite is true. The more out of the money, the less the delta is. Now, the value of the options premium doesn't move linearly, which means that just because it moves a certain amount per $1 move, if it moves again, a dollar again, it doesn't move exactly the same amount. And that change in the delta amount that it moves per dollar is controlled by the next Greek, and that is gamma. So gamma measures how much delta might change with each $1 move of the underlying stock. So for example, if you have a delta of 25 and you have a gamma of 5, so the first dollar your underlying stock increases, the option will move 25 cents. So if it increases a dollar, it'll go up 25 cents. And if it decreases a dollar, it'll go down 25 cents. Now, on the second dollar increase, it'll actually increase that 25 cents plus the gamma. So if it goes up, it'll go 30 cents the next time from the next dollar increase. So gamma helps you understand whether an option is getting more or less sensitive to price changes. So gamma also changes over the life of an option. So it gets larger as the option nears expiration. So that's known as gamma risk. So when an option has gamma risk, it has a large gamma, and therefore, whenever the price changes, it actually moves more. So that can lead to large swings of options, the option premium. So gamma is typically largest when it's at the money, and in those situations, even small movements in the underlying price can make a large difference. So I'm going to go back a little bit. When we go back to the delta. So just because it's talking about dollar moves doesn't mean that the stock price has to move a full dollar for you to see that delta go up or down. It actually works in 10-cent increments also. Now the next Greek is called theta, and theta measures how sensitive an option is to time decay. So each day you hold on to a premium, an option premium, and the closer it gets to the expiration date, you get a larger time decay. So on long calls and puts, theta is always negative because theta always subtracts from the total amount of your option premium. So for example, if an option has a theta of minus 2 cents, we'll lose 2 cents of 2 cents of value every day you hold that option. And that includes the weekends also. So others, like just like the other Greeks, theta doesn't stay the same, and it increases or decreases, or sorry, it increases as it gets closer to expiration. So which means that the closer you get to expiration, the more money you'll lose per day as you hold on to that option. So that's why a lot of times buy options 30 to 60 days out, so that your theta, which is your time decay, isn't really a factor. Even if you're day trading, if you only hold and you end up having to hold the option for a couple days, your theta or your time decay isn't really much of a factor. If you bought an option only a few days out from expiration, your theta would be a huge factor because it's quite large right before the expiration. I think the last week of expiration is actually like where you kind of want to stay away from. Now theta tends to be the largest in at the money options. So vega is our final Greek, and this measures the implied volatility. So it measures how much the option premium changes with every 1% change in implied volatility. So if the implied volatility, which IV is what IV stands for, tends to increase when a stock or its sector or the overall market falls in price. And those declines tend to increase perceived risk. And so the larger the risk, the larger the implied volatility. And it also increases for major announcements and events, like Fed announcements or earnings announcements and other economic events that are on the calendar. So here's the example. I'm going to actually go back. This is the example that I have for how all of the Greeks work together. So let's say day one, you buy an option on the underlying stock that's trading at $45 a share. So you buy a call. So your options price is actually $1.30. So you're paying $1.30 per share. So for 100 shares, which is what the option controls, you're actually paying $130. Now, your delta is at 35, so it's out of the money at this point. So 35 cents out of the money, because 50 cents would be at the money, and anything above 50 cents would be in the money. So your delta is 35 cents, so you're out of the money at this point. Your gamma is at 6 cents, so that means that every day you hold on to, so every dollar your price changes, your gamma will affect the delta by 6 cents. And then theta, which is your decay, so every single day 2 cents will come off of your options price. And then finally vega, which is implied volatility, is at 7 cents. So we're going to actually see how this works together. So from day one to day two, the stock goes from 45 cents to $46, $45 to $46. And in that time, your options price now goes from $1.30 to $1.65, which is the options price plus the delta of 35 cents, which makes $1.65. So then you subtract your theta. So now your options price is $1.63. So that's on a one-day move. So nothing else affects it because you only moved that one day. So now we'll go from day two to day three. So day two to day three, your share price goes from $46 a share to $47 a share. Now your options price is at $1.63. Your delta, which is 35 cents, now increases by the gamma, so it goes to 41 cents. So now your options price, instead of only moving 35 cents up, it moves 41 cents up to $2.04. So now at $2.04, you have to take in effect the theta because it's moved another day. So the theta now brings that down to $2.02. But then there's one more thing. The implied volatility, or the vega, has gone up by 1%. So if that happens, then you add an additional 7 cents to your options price. So now your call option is worth $2.09. So that's how all four of the Greeks work together in order to price an option. So I hope that helps. And if they have any questions, you can ask me. But this is kind of a hard concept to learn, and it takes a little while. I've actually watched videos on this more than a couple times in order to get this correct. So I hope this this visual helps a little bit more in making you understand how the Greeks work. Thanks guys for watching my video, and I will see you on the next one.